Hello, class. I want to take a few minutes to talk about current liabilities. Right now, current liabilities, by definitions, are debts and obligations that are due within 1 year. They're classified on the balance sheet as current liabilities. Okay? Any liabilities or obligations that are due beyond a year are considered or classified non-current liabilities or long-term debts. Okay? Some examples of current liabilities include accounts payable, wages payable, salaries payable, short-term notes payable, and different types of taxes payable, such as sales tax, income tax, and payroll taxes. Now, here's an example of a company that borrowed $50,000 and issued a note. Okay. Now, they issued a $50,000 4% 6-month note on February 1st. Okay. Now, when you look at this, the different components of this note, okay, first of all, the 50,000 represents the face amount of the note. Okay, so that is called the face amount. The 4% represents the interest rate, and that is an annual interest rate. The 6 months is how long the money is going to be borrowed. So actually the $50,000 is due in 6 months. Okay, and February 1st represents the date the note was issued. Okay. So first of all, if you want to calculate the due date of the note, okay, since it's a 6-month note, we're going to count 6 months from February 1st. Okay, now we're going to ignore February 1st and start with March 1st. That'd be 1 month. April 1st would be 2 months. May 1st, 3 months. June 1st, 4 months. July 1st, 5 months. And August 1st would be the 6th month. So the due date would be August 1st. If you're trying to calculate the interest expense for the 6-month period, okay, you have to keep in mind, again, that interest is calculated by taking the principal or the face amount times the interest rate. But again, as I mentioned earlier, the interest rate is an annual interest rate for 12 months. But since Solomon Inc. here is only borrowing the money for 6 months, we have to adjust the interest. So here's my calculation where I take the face amount times the annual interest rate. That gives me $2,000. But I'm going to adjust this $2,000 and only take half of it, 6 months worth. So I multiply it by 6 months over 12, and that's how I get $1,000. Now when you take the $50,000 that's due in 6 months plus the interest that's due in 6 months, right, and you add those up, that gives you something called the maturity value. So the maturity value is $51,000. Some notes are not issued in months but in days. So this note is a 180-day note. Okay? So when you calculate the interest, instead of using months in this calculation, we're going to take days, so 180 days, and I'm going to divide it over 360 days. Now I know there's 360 days in a year, but for class purposes and for test purposes, okay, calculate interest based on 360 days. Okay, but in the business environment, again, we actually use 365 days. Now moving on to payroll, right? I want to discuss two areas. One is employee payroll withholdings, and the other area is employer payroll taxes. Okay. When it comes to employee payroll withholdings, okay, those are the taxes and other deductions that an employer is required to withhold. Okay, and they're going to withhold that from our gross pay. Well, what is gross pay? Gross pay is taking your regular pay, right, plus any overtime pay. When you take the sum of those two, that is considered your gross pay. So it's regular pay plus overtime pay is gross pay. Gross pay is before any deductions for taxes or any other withholdings. Now net pay equals the gross pay. In this case, it's $1,200 minus any deductions or withholdings, right? And here it gives us $850, and that is considered your net pay or take-home pay. Okay? So employee withholdings. Employers are required by law to withhold certain taxes from their employees' periodic earnings, meaning their weekly earnings, their biweekly earnings, or monthly earnings. Okay? The three most common taxes that they're required to withhold are going to be Social Security tax, Medicare tax, and federal income tax. Now, Social Security tax and Medicare tax are referred to as your FICA tax. Okay? They're made up of two components. When it comes to Social Security tax, there's an annual limit on the amount of tax that we as employees have to pay into the system. And that is based on a certain threshold earnings amount that is adjusted every year. So let me use this as an example. Let's say for the current year, the Social Security tax annual earnings maximum is $100,000. So for every dollar you make under $100,000, you're going to pay a certain percentage of tax. However, for every dollar you make over $100,000, you no longer pay Social Security tax. On the other hand, Medicare tax has no limit. So basically, whatever you earn is subject to a Medicare tax. And that goes the same with federal income tax. All earnings are subject to a federal income tax, but the calculation is slightly different for federal income tax as it is for Social Security tax and Medicare tax. Here's an example or illustration of the specific taxes being deducted, right, to arrive at net pay. So this person has a gross pay of $1,200, and we calculated a 6% Social Security tax. So 6% of $1,200 is $72. The FICA Medicare tax, I'm using a 1.5% rate. And so I take 1.5% times $1,200, the gross pay, and that gives us $18. And in the federal income tax, that's a given number, okay? And so I put $250 here. So when you add all these taxes up, okay, these are the withholdings or deductions. And these deductions are going to be taken out of your check, held by your employer, and your employer will go ahead and pay those taxes to the government. So what you're taking home is your net pay or take-home pay. Okay. Oh, by the way, the gross pay is $1,200 would be the salary or wage expense the employer would record. Okay. And this would be the salary or wages payable. And these would be the taxes payable. Now, employers also have payroll taxes. Employers are required to pay these taxes based on employees' periodic earnings. And that includes also FICA, right? Social Security tax, the FICA Medicare tax. In addition, there's two other taxes: federal income tax. Federal unemployment tax, right? Called FUTA, and state unemployment tax called SUTA. Okay? So again, the employer bears the burden of these taxes. When you look at the Social Security tax and Medicare tax, basically the employer is matching whatever the employee is paying into the system. So if you have to pay 6% into the system, the employer has to match that. So they're contributing into your Social Security fund. The limits still apply for Social Security tax. Again, there's no limit for Medicare tax. Now, if you look at the other two taxes, the FUTA and SUTA, there are annual limits on that as well. Okay, and the limits are pretty low. It's roughly about $7,000. So for each employee that earns up to $7,000, the employer is going to pay into the pay FUTA and SUTA. Once that employer has reached $7,000, the employer no longer has to pay into food and soda for that year. Moving on to pensions, right? There are two basic types of pensions, right? And a pension is basically like a retirement plan. You have a defined benefit plan, and you have a defined contribution plan. Now, most of you guys are probably more familiar with a defined contribution plan, such as a 401k, a 403b, or 457 plan. These are employer-sponsored plans. And with a defined contribution plan, the best way to understand this is whatever you contribute into these plans, right? In general, all the earnings are growing in that account, tax-free, or let's just say before taxes. All the taxes are deferred. And when you take the money out at retirement age, that's when you'll be taxed. Okay. Oftentimes, employers will contribute into your retirement account as well. So you contribute as well as your employer. Okay. But most of the contributions are going to be coming from the employee. So your benefits, when you come to retire, is really dependent on how much money you decide to invest and save in these plans, such as a 401k plan. Okay. Now, upon reaching retirement age, okay, you as an employee may withdraw some of the funds, all the funds. Most employees will take a certain portion of it, every year, to supplement, their living expenses. That you may have Social Security benefits, but your main retirement fund should come from your 401k or your pension plan. Now, going back up here to a defined benefit plan, okay, you don't see too much of these around anymore. However, most government agencies, colleges, universities, fire departments, police departments still have these type of plans. Okay, so here in California, as an instructor at the community college, we have STIRS, or a state teachers retirement system. There's also PERS, right? These plans are a little bit different because your pension benefits when you retire are based on different factors. One being the age at which you decide to retire, the number of years of service, and typically your highest salary. So let's say, for example, you worked for a college and you decided to retire at age 65. You have 30 years of service and your highest salary is $100,000. Okay. Now, to calculate the pension benefits, basically you would take, at the retirement age, let's say there's a certain percentage factor of 2%, okay? And you're going to multiply that times the years of service. So 2% times 30 years of service. Okay, so that gives you 60%. And you take your highest salary, so 60% times $100,000, so that gives you $60,000. So that would be your pension benefit when you retire, your annual pension benefit of $60,000. So in this case here, again, it's different from a defined contribution plan. Keep in mind, a defined contribution plan, your benefits are dependent on how much you contribute into the retirement account and how well your funds do in your investments. Whereas a defined benefit plan is really based on your age, how many years you work for that employer, and your salary when you retire. Moving on to fringe benefits. Okay, now the cost of vacation days and sick days must be accrued and reported as an expense and as a liability when employees earn vacation days and sick days, not when they actually use the days. So for example, in a particular year, let's say an employee earns 14 days of vacation, right? And this is in 2016. But the employee is going to use the days in 2017, which is a different accounting period. Well, the company must record the cost of the vacation expense and record a vacation payable at the time or in the accounting period that the employee earned the vacation days or sick days, not when they use them. Okay, so since the employee earned the vacation days in 2016, the expense is going to be recorded as well as the payable, the liability, will be recorded in 2016. And moving on to contingent liabilities. Okay, so contingent liabilities are potential obligations that may arise based on future events, such as a lawsuit. Okay, a product warranty is often cited as a contingent liability too. Now, companies are required to report contingent liabilities, okay, in the financial statements if certain conditions exist. Okay, the contingency is both probable and the amount can be estimated. Okay, if both conditions do not exist, okay, then the contingent liability is not reported on the balance sheet. Instead, it may be reported in the notes or completely left out. Okay. In this example here, okay, I'm going to discuss how companies would have to account for a contingent liabilities related to a warranty or a product warranty. So Nemo Inc. sells $100,000 of merchandise in June and estimates a warranty expense of 3% of sales. So what that means is they expect that 3% of the $100,000 of merchandise sold will result in some sort of warranty repair. So when you take 3% of $100,000, that's $3,000 they expect to spend on fixing defective products under the warranty period or during the warranty period. Now in August, Nemo spent $75 on labor to repair some defective merchandise under warranty. Okay. So the question is, what does Nemo have to record in June and what does Nemo record in August? When is the warranty expense recorded? The warranty expense is going to be recorded not in August when the product is fixed, but actually ahead of time when the product is sold. So since the sales occurred in June, Nemo would record the following: a warranty expense of $3,000 and a warranty payable of $3,000. Okay. In August, when the repairs are made, the warranty payable is adjusted. Right? It's kind of like the allowance for doubtful account we talked about in the receivables chapters, right? That warranty payable is kind of like an allowance. So as we actually repair a defective product, okay, we reduce the payable. At the same time, assume we incurred labor expenses to repair that product. Okay, we're not going to record a wage expense, we record a wage payable. Okay? In lieu of the wage expense, we're calling it a warranty expense. Hopefully that makes sense.